The Conference Board is a global research and business membership organization and publisher of the Consumer Confidence Index and the leading economic indicators. I'm pleased to be joined by Conference Board CEO Jonathan Spector. Welcome to CityWide.
Thank you.
So over the last season, we've been looking at the policy shops of New York, the advocacy organizations and think tanks that provide the fuel for a lot of public policy debate. The Conference Board is more of a data shop than a policy shop. Why don't you tell us a little bit about what you do?
Well, hopefully we're a bit more than a data shop, but I do take the point that we're not advocates for public policy. We don't lobby. We're avowedly nonpartisan. We basically do two things. We conduct research and we convene executives in various different forums. In the past year, probably about 20,000 executives from around the world would have met in one of our conferences. We have private councils that meet 2 or 3 times a year as a small group of, say, 30 executives. We hold public meetings. We hold private meetings on various issues. And our research is focused on 4 areas. On economics, you mentioned the indexes. We do other things as well. On economics, on research on human capital, talent management, and leadership, and things of that sort. Corporate leadership, leading corporations, governance, and environmental issues and risk. And then operational excellence. So it's both research and convening. And so there's a think tank aspect to it. But again, as you pointed out, we are not advocates.
Tell me what leading indicators mean. How do you capture the data? Why is it important? How do we know it's significant?
Right, it's a great question. At a very simple level, a leading indicator is an indicator of how the economy is likely to do 3 to 6 months from now. It's a macroeconomic indicator. It doesn't say how many cars will be sold or what the earnings of a company will be. It's more a general performance indicator for the economy. It is a prediction, and what we've done over decades is to analyze multiple dimensions of the economy: inflation, jobs, unemployment index, the money supply, interest rates, a whole variety of factors. And we have built what we call a coincident index. That's how is the economy performing today. Right. And what we do then is try to predict how that index is going to perform 6 months from now. And we try various different combinations of factors. And through, again, decades of analysis, we've come up with the best predictor of what that index is going to look like. So technically, the leading economic indicator is a prediction of what our current index will be 6 months from now.
And what's your accuracy rate?
Well, it's hard to answer that question. It's pretty good. Let's put it this way: it's good enough so that everyone uses it, or many people use it. Economists, political folks, policymakers, the private sector, the stock market analysts use it as one of their important indicators for trying to assess how the economy is going to do. Obviously, there are certain events that are unpredictable, and our indicators, don't take that into account. But I think they're very robust. They've been tested over decades, and I think most people use them as the sort of best measures available.
And these are basically calculations made by a staff of economists?
Exactly. We have economists. They all have academic credentials. They're focused just on these issues. We have a team of 4 people that work exclusively on the indicators, and they've been trained to do this. And we've been doing it for a very long time.
Now, the Consumer Confidence Index, which is, I guess, one of the most widely quoted figures.
Yes.
You see it in the business news all the time. What is that? Is that more of a poll?
Yes. That is conceptually used for the same purpose as the leading economic indicators, but the construction of it is very different. The leading economic indicators are data. The Consumer Confidence Index is a poll. Every month we reach out to 5,000 consumers.
That's a big sample.
It's a huge sample. And that's one of the strengths of our index. It's a huge sample, and we get a 70% response rate, which in market research terms is unheard of. And it's really because of the history and the familiarity that everyone has with it. And so we have an enormous sample, and we ask some very simple questions about current attitudes and employment, and future expectations, again, sort of 6 to 9 months out. It's a very simple calculation. It's been done the same way, I think, since the 60s. And so it's very comparable, meaning you can compare it over many decades.
And why is that information important?
Well, I think that's an excellent question right now for our time, because I think that as we face economic pressures in the United States, many people are worried about the interaction between, let me say, the real economy and the expectations economy. And there obviously are interactions between those. Expectations can hurt, good or bad expectations can influence the economy. Understanding what those expectations are is very important. If you are a manufacturer of a consumer product, which is a huge part of our economy, more than half of our economy is driven by the consumer sector, and consumers' expectations of their own wealth and affordability is going down, you need to consider that in terms of your business plans. If you are a business that serves those consumer companies, which is essentially the rest of the economy with the exception of the government, you need to be worried about what your corporate customers are going to be doing. So it really affects almost all sectors of the economy with the exception of the government sector. And I think that in turn affects the stock market, it affects the banking system, it affects really everything about our economy.
There seems to be a lot of uncertainty, lack of confidence,
right,
even among business leaders, economists,
right,
conflicting data, people reaching different conclusions. I mean, obviously there's always going to be a range of opinions
right,
on things, but there seems to be a particular high level of uncertainty right now. Is it justified? Is there an answer? Are people looking at the wrong data, or are we just in a period where nobody knows what's going to happen?
Well, I think partly what is happening, and it's been happening consistently for quite some time, I mean decades, is that the economy is just getting more and more interconnected and more complex. It used to be, for example, that the energy purchases of China would not be on the radar screen of business executives in the non-energy sector in the United States. I mean, if you were, even if you were heavy manufacturing, if you were Texas
right,
Instruments or Hewlett-Packard, you wouldn't care how much oil, or even know how much oil China was buying. Today, that's having a huge impact on oil prices in the United States. So it's a simple example of how an interconnected economy makes things much more complicated. I think part of the confusion may be somewhat permanent, perhaps not at the level that we're at now, until, and it may take 5 or 10 years, until the economic models and the frameworks and so forth can take into account the greater global complexity. Now, we've been globalizing for a long time, but I really do think that in the last 3 to 4 years, the impact of China in particular, and also India, has had a disproportionate effect on the global economy, and therefore we're sort of struggling to catch up a bit.
There's also an explosion in the amount of data that's available, the ability to track
right,
stock prices over
yep,
long periods of time, the number of commentators who are distributing their information through
right,
the web, or having it, the echo chamber, if you will. Very difficult for people to sort through what's real and what's not real, and then the perceptions create their own perceptions.
Right. No, I think that's right, and I think that the internet, very specifically, is enabling that, if you want to look at it on the positive side, or causing it if you want right, to look at it on the negative side. And I think it's actually important for us to realize that we're actually at the beginning of the internet phenomenon, not at the middle.
What do you mean by that?
It's really only been a couple of years where you would assume, as a matter of course in the business world, that the person at the other end of an interaction was online. If I remember being in a discussion with some companies a few years ago and asking them, well, why don't you just get rid of your paper billing and just send everything out by email or post it on the web? And they said, well, we'll offer that as an option, but we won't do that unilaterally because there's so many customers who we don't know if they have email, right, or not sure. That was as recently as 3 to 4 years ago. Now, obviously, companies still offer paper billing, to use that example, but the presumption that a customer is online, if you're not online, the presumption is, well, maybe right, you need to
right,
be. So we're really, I think, at the beginning in the larger context, we're at the beginning of the internet era. And I think it's only going to get worse or better, again, depending on your perspective. More information, much more information is going to become available. And the analytical tools and insights and synthesis that think tanks, for example, provide, I think are going to become more important over the next 5 to 10 years. I also think the modeling will become better. And maybe that'll reduce the uncertainty a little bit. It won't be perfect, but I do think that we're trying to catch up in terms of accessing all the information that's available. We're probably in a catch-up period.
The integrity of data and the integrity, I'm not talking necessarily about what the kind of stuff that the Conference Board captures, but the reporting by financial institutions and public companies has also become more transparent, one would think, because of Sarbanes-Oxley, but as we're seeing now with the subprime and the credit crisis,
right,
more opaque because of the kinds of special purpose vehicles
right,
that were created to monetize assets and transfer them around, to the point where it plays out in a courtroom in a foreclosure case when the judge says, well, we don't actually know who owns the mortgage, right, on this. How confident can investors be that they actually understand what's happening in the companies that they're investing in?
Yeah, this is a very important issue, and it's actually an issue that we have been researching, and we're accelerating our research into the issue, the broadest issue of financial stability. And I think the subprime crisis in the U.S. is a good technical example of that. Let me just caution your viewers that you use the word integrity, and I think you were using it in the broadest sense. This crisis is not an issue of corporate integrity in the narrow sense.
Right, it's not about Enron people cheating.
This is not about fraud. It's
right,
not about transparency or opaqueness. It's about complexity. Now, there's a real problem. But the problem is one of technical complexity. The securities, the special purpose vehicles that you described have been created to have been enabled by the new technology. Just the ability to calculate and create them just didn't exist before. And the products got created in a way that the products themselves are inherently so complicated that they really are difficult to measure and so forth. I'm confident that the financial services industry will work its way out of this problem. The information is knowable. It's not lost forever. It just takes time to calculate it, and we don't have the systems yet. Once that happens, I think the transparency will increase. I think this is a short-term problem, not a long-term problem.
We're going to continue our conversation right after this.
Hello, I'm Della Reese, and I'd like you to meet Faith in Action. Faith in Action means people keep their independence by getting help from volunteers, people of different faiths who shop, cook, drive, or just check in on some of the millions of Americans with long-term health care needs. A neighbor's independence depends on you and me. Faith in Action. Try it and see how good it feels.
Welcome back to CityWide. We're speaking with Jonathan Spector, CEO of the Conference Board. So we were talking about expectations and the confidence that investors and consumers can have in the economic data that they see in integrity. One of the initiatives of the Conference Board is a Commission on Public Trust and Private Enterprise. Tell us what that's about.
Well, that was convened in 2001 in response to the corporate scandals that had taken place leading up to that point. And one of the roles that we can play as a nonpartisan organization is to convene people without an agenda, to convene people and they won't be seen as having an agenda or a bias. We convened a dozen senior folks, some executives, some public figures, a Supreme Court justice, our chief economist, and some other folks, to basically think through the issues of what are the pressures that are placed on senior corporate executives, what are the obligations and the requirements for governance, and issued a report that was, indicative of the kinds of changes that we think needed to be made. And many of them have been adopted through Sarbanes-Oxley and through other sorts of practices or regulations and so forth.
Your organization operates, you're based in New York City, and we're going to talk a little bit about New York in a second, but you run programs all over the world and link executives all over the world. Could you talk a little bit about what the benefits of that are from their point of view, and also about the logistics of how you manage an enterprise like that.
Right. I was just on the phone this morning at about, 7 a.m. this morning, talking to the head of our Hong Kong office. For him, it's in the evening. It's one of the times when we can talk when neither of us is asleep, talking about the effectiveness or lack of effectiveness of video conferencing and webcasts. In Asia, webcasts are less accepted than they are here. And so when we try to bring executives, in this case, we're trying to bring executives in Australia, Hong Kong, and the US together on a common topic. And it's somewhat unacceptable in China to do that by video. From a time zone problem, we can't get all three places at once. So it's very difficult. We have, but it's very important for our corporate members. I mean, we are a corporate membership organization, and most of our members are big global companies, the Fortune 500 or the Global 500. So all of them operate multinationally and globally, and they move their executives around from place to place. They face issues that are common across their corporation. But the solutions are often need to be refined for the local environment. So if we're talking about talent development or governance or diversity or even direct marketing or supply chain, the nuances of that issue are going to be different in China versus in Brussels versus in New York. So it's very important to our members to be able to get those perspectives from multiple geographies. The logistics are a real complication, and we don't have any great answer for that.
This is a presidential year. You're a nonpartisan organization. And I'm respectful of that. But one of the issues of debate is whether the stature of the United States has been diminished over the last few years. One could argue based on policy initiatives of the White House, and people can, reasonable people can differ about that, but also that America's economic standing has been diminished. The dollar has dropped in value. Other economies are in Europe as well as in Asia are outpacing us, it appears to be. From your perspective of dealing with people around the world, is it just that traditional, we're being picked on kind of a thing, or is it a genuine issue for the United States as to whether it's going to have the same leadership role moving into the 21st century?
I think it's a genuine issue, and I think it can be addressed. I think there are many dimensions of it. One, I think, is just the natural economic cycle or cycles of economic development. I mean, we should be outpaced by developing economies. That's what developing economies do, and we were once one. The weak dollar sounds bad, but in fact, it has, as a result of the weak dollar, exports in the United States are growing at 13% a year, and they've been growing that rate for 4 years, which is an enormous boost to our economy and to our local employment and so forth. So I think that a weak dollar is not necessarily a signal of a weak economy. But there is an issue here. I was speaking with the CEO of one of the largest banks in the world, a non-American bank. And he said he is not an American native, but very fluent with this country, has worked here, has lived here perhaps. I don't know his exact personal background. And he said, in a very heartfelt way, we, my colleagues in Europe and around the world, are really confused about the United States, and it's the first time in our careers that we can remember this. You need to tell us where you're going. And so I don't take that as I take that as a solvable problem. I don't think it's a permanent indication that the U.S. doesn't have a leadership role. In fact, it's really, I think, an aspiration for the U.S. to play a leadership role. But I think that we are, for a variety of reasons, the picture of where the U.S. is going just isn't clear to some business executives outside the U.S. And I think if that position is sustained for 3 or 4 or 5 or 6 more years, it could seriously erode. It could begin to fundamentally erode our competitive position in the world. I don't think it has yet, but I think we need to address it.
Let's talk a little bit about New York City for a second. The city has rebuilt itself from where it was in the 70s, 80s, even into the 90s. September 11th could have marked a turning point and abandonment by the business community. Instead, the city is in very strong shape, but its global position in world finance seems to be under some challenge. And I was wondering again, from your sort of 100,000 foot viewpoint of talking to people all over the world, what is the perception in the business community of New York City today?
It's very, very strong. I mean, New York is the #1 city, and I don't think that that's, to be honest, I don't think that that's changed. I do think that it isn't the only city anymore. I mean, I think London, obviously, from the financial markets, and Tokyo, to some extent, have always been important cities. But I think there's a realization, as globalization has occurred, and again, as technology has enabled the rapid movement of trading books and financial products across borders instantly, that there isn't, that being the #1 city isn't going to mean the same thing now as it did 20 years ago. So I don't think this is, again, any evidence of a weakness in New York. It is just the reality that we have peers now, right. And we have many places that are aspiring to be financial leaders. I think that's a good thing. I lived in Taiwan for 5.5 years, and Taipei was trying to become a financial services capital in Asia. Now, it hasn't succeeded, but the effort to do so was extremely good for the economy of Taiwan, for the citizens of Taiwan, and for multinationals operating there. Because to be a financial center, one needs to liberalize the laws, needs to adapt to international standards. All of those things are really good developments. So I think the fact that Taipei is trying to do that, Singapore and Hong Kong, Dubai, obviously London, Tokyo, and New York, Chicago, San Francisco, I think that having cities attempt to play leading roles in the financial sector is a good thing for the global economy. New York has, and personally, I'm a New Yorker. I was born here. I think New York will always have something unique about it. It's an extraordinary place, and I think people all over the world recognize that.
Well, you know, the competition with the Conference Board that comes uniquely out of New York is the pizza index, where people talk about the price of pizza being tied to the rate of inflation. That's sometimes the subway fare, and I have to say, the last time I had a slice, it was $2.50, but I saw in the newspaper that there's one pizza place now that's charging $4 a slice. So, you know, is this consistent with the leading indicators?
Well, if I have to have our economists opine on that. Let me get back to you on that.
If you were to say one thing to our viewers about what they should be looking for in the financial news in the next few months, what's the trend that the leading indicator that is best going to signal to them whether things are moving in the right direction or the wrong direction? What is it that the average layperson should be looking for?
It's a hard question because, again, the economy is very complicated and there are so many things. I think one thing that the average consumer can look at is the degree to which the government is adopting very substantially new and aggressive policies. I think if the government decides to, for example, the economic stimulus package, that's a significant policy, but it's not a radical departure from what's been done in the past. It's some monetary policy, keeping interest rates low, injecting some capital through tax refunds. That's sort of the normal course of affairs. And remember, the economy has cycles. It goes up and down. If that's what we see coming out of the government policy and the government actions over the next 3 to 6 months, I think we can say to ourselves, okay, things may be a little tough, but we're responding through policy measures, and we've seen these things before. We're going to make it through. I think if we start seeing more radical initiatives that appear to be needed and that the government is going well beyond what it's currently talking about, then I guess that would be a sign of concern that maybe things aren't typical. But I think we have to remember, we have an economist who is in his late 80s, Victor Zarnowitz at the Conference Board. He invented the concept of business cycles. The economy cycles. It goes up and it goes down, and it's perfectly normal to have it do that. I understand that people are affected by it. I'm not trying to minimize that. But this is not, there's no reason for us to panic. And the economy is weakening, it will strengthen again, and it will weaken again. And you can look back, and our data shows over decades this happens. And
in fact, that's the value, the leading indicators and also the data looking backwards that we can have confidence in. My thanks to Jonathan Spector, CEO of the Conference Board. I'm Ken Fisher. Thank you for joining us on this edition of CityWide.